Let's pretend that we're not in 2023, but we're in 1923. Mm-hmm. And in 2023, you think stock markets can only go up, or 2022 actually. You think stock markets can only go up because you've seen 10 years of stock market going through the roof. If you'd been in 1922, you'd have thought stock markets could only go down because 85% of the time you'd been in a bear market for the previous, not quite 100 years. And if you extrapolate over a longer time frame, you don't think about stock markets can only go up. The last 40 years has been an exceptional period because they've been driven by falling interest rates. I mean, the primary driver of valuation is interest rates. And the lower the interest rate, the more value there is for future cash flows because you're discounting them at a lower rate. Conversely, if you've got high interest rates, the value of something in 20 years' time is less today than it would be if you've got low rates. So very simple philosophy. So what we've had from 1982, we've had interest rates went, long bonds went from 15% or 18% at one point down to negative yielding bonds. So, but effectively, we've had rates go from 15% to zero. And now you've got rates at 5%. And rates are not going back to zero because central banks have realized that having zero interest rates is not a good idea. It creates all sorts of distortions in the economy. Money becomes too cheap. It gets misallocated. It's really, really bad for the economy and for society. And I don't
took them 14 years to realize, though, didn't it?
Well, I think that they couldn't really see another way out. But obviously, with COVID, the situation changed. And now I believe we've got endemic inflation. I know that might sound a bit odd because as we speak, we had US figures yesterday which showed disinflation. But
the service numbers are still high in the UK, though, aren't they?
I mean, I tend to look more at the United States. The UK is kind of a peripheral economy, and I try to think about the world. The UK stock market is very cheap, but it's been very cheap for a long time. And the UK economy it's not really creating, the UK stock market isn't about the UK economy.
No.
So I try and think about, America as being the principal driver. And, but my view is that inflation is here to stay. Interest rates are not going to zero anytime soon and probably never. And if you've got higher inflation, higher interest rates, that means valuation is not going to go up as it has. And that means you've got to be driven by earnings. And lots of companies are going to grow their earnings, but we've had a very bad situation in which we've had a huge amount of inequality in the world. We've had corporate taking a much bigger share of the cake than labor. And workers are going to be taking a bigger share now. And that means that corporations aren't going to see their margins expand from already extremely high levels. They aren't going to expand as they have done over the last 40 years. So you've had a stock market that's gone up at 8% per annum for the last century. And it's highly unlikely it can go up at 8% per annum for the next century. It's just, the maths just doesn't work.
This clip was from our interview with ex-hedge fund manager and analyst Steve Clapham. Click here for the full interview.